morning, everyone. Thank you for joining us today. My name is Jeff Huang from eXp Realty, your 2022 Education Committee Vice Chair. Some quick housekeeping items before we get started. All participants will be muted in the meeting. Please enter any questions you have into the chat box. The speaker will answer your questions during the Q&A toward the end. This session is being recorded and will be available on our YouTube channel, West San Gabriel Valley Realtors. Our awesome co-host today is Christine Chow, who will introduce our topic and guest speaker. Christine, take it away.
Thank you, Jeff, for the introduction. And today we have the honor of having a guest speaker, Jeff Huang, also Jeff Huang, but he's a CPA and MBA. He's a seasoned certified public accountant with over 20 years of experience with public accounting, including experience in Arthur Andersen, one of the big fours. And he has worked with Fortune 500 firms. He specializes in small and medium-sized business management and tax planning, real estate taxation and planning for national taxation, IRS, audit representation, startup business, accounting, financial reporting, and management consulting. Jeff received his master's degree in business administration from University of California, Riverside, and a bachelor's degree in chemistry from one of the top 10 universities in China. So we're very proud to have Jeff here with us because he's been a longtime member of our association and he has a license in real estate and contractor. So take it away, Jeff. We're very honored to have you here. Let's give him a warm welcome.
Thank you, Christine. Thank you, Jeff. Let me share my screen here. First of all, I would like to say thank you to San Gabriel Valley Realtors Association. Thank you for all the arrangement, phone, and also Christine and Jeff. Yeah, so it's my great honor to be here to share my professional knowledge and experience on the tax field side. And also, as Christine mentioned, that I'm the longtime member and I'm proud of the member of West San Gabriel Valley Realtors. So I'm the member since 2001. So I'm 21 years membership here. So let me share my screen, and today's topic I would like to talk about 2020, the new tax update. Let me see here. Yeah. Okay. Also, that I lose my chat here. So let me share screen one more time. Okay. So as a real estate professional, every day we're helping the client to buy and sell the house. So for this year, the house market is very good. A lot of our clients make a lot of money on the real estate side. So one nice problem they have is tax. So today we talk about the new tax update and talk about the tax saving strategy for our real estate investors. So before the meeting, I know that a lot of you have the open house or have the listing. Right now, you will get multiple offers. So, I mean, our clients are very happy. And with your help, professional help, they make a lot of money. So that's very proud of as a real estate professional right now. Yeah. So, and also the data net problems, how to help the clients to save the money on the tax side and how to help them keep more on their pocket. So thank you for the introduction for Christine. So one thing I would like to be emphasis, I'm very proud of the member of West San Gabriel Realtors Associations. So since 2001. And also right now I handle the IRS audit representation. So I would like to share with you my experience on those on the other side. So today's agenda, we go over recent update and we talk about the top tax saving strategy for real estate investor. And the next one, I know that a lot of us will come with questions from our clients. Can I use my primary residence in a 1031 tax deferral exchange? So at the end of the presentation, I will give you the answer. And also it depends on and how we can do to help the client achieve on the primary residence in a 1031 tax deferral exchange. And also I would like to bring up to you on the IRS section code. So that way you know that you have something to base on. Okay, let's take a look at the most recent update. The things I would like to share with you, I know that for the last few weeks, the mortgage rate is up and down. Just refresh your memory. That's the graph for the last 24 months. So you can see that we have an all-time low in January 7, 2021. And after that, the interest rate is up and down. And if on the February 17, it come up to 2022 high. It's come up around 3.92% the interest rate. So you can see that over the next 90 days, the interest rate is still high, but it's below to 4%. So still up and down. So maybe it changed a little bit our housing market. Maybe the way our client doing buy and sell houses is different. So the other things I would like to bring up to you is the new update. I know that most of you heard about the proposed AB 1771, which is introduced by Assembly Member Chris Ward from San Diego. So I will give you the quick point, the main point on the AP 1771. It's known as the California Housing Speculations Act. They will charge additional 25% capital gain tax on almost every residential property sold within 3 years of purchase. Again, this proposed AP 1771. And if we take a look at the detail on that, so if every primary resident in California within 3 years, additional 25%, 3 to 4 years, 20%, 4 to 5 years, 15%, and 5 to 6 years, 10%, 6, 7 years, 5%, is greater than 7 years, none. So that's most might be impact our real estate industry and how the client to react for those stuff. So if this proposal pass, it will impact on the investment property, and maybe for the primary house, they will have more people, more demand, but less supply on the market. So I mean, they have the we have solution, because I mean, like after this comes up, and my team do a lot of research. That's the reason we come up about 12 tax saving on the real estate investment. So we can come up the solutions, and if this pass, we have solutions to solve problems. So I'm not sure one of my team members here. I would like to introduce my partner, John Wang, CPA. He also in the meeting, so he joined us because right now we would like to be learn and hear from everybody feedback. So how we work together to solve those problems. So for me, I would like to give you later, I mean, those tough tax saving strategy later on that. So before we go down to here, I would like to give you some tax law change. The first thing is regarding business meal. As everybody know that in 2021 and 2022, you can be 100% deduct on the business meal. So let's take a look at the detail on that. So that is the before and after on a deduction. So before, if you go to restaurant for the business meal, it's only 50% deduction. For this year and last year, it's going to be 100% deduction. So I know that a lot of us is working on the 2001 tax return. Don't forget, business meal for this year is 100% deduction. So when you finish the tax return, make sure that you look up the business meal. It's not as 50% deduction as last year. So that's one thing I would like to draw attention on that. So the other things I would like to draw attention, entertainment is no longer deduction. So for example, you invite the client to go to the Lakers game, and the ticket to the Lakers game is not deductible. But if the Lakers game, the ticket including the meal, and the meal portion is 100% deduct on that. And also one thing I would like to draw attention, the personal meal as before cannot be deduct. So lately I do the audit representation. One of the people bring up the whole bunch of receipt on the meal side. So I think that I see that every morning he go to McDonald's, buy the coffee or $5 or $7, and definitely the audit won't let it go, because that is the personal meal on that. So I would like to give you the suggestion. how to make the meal deduct. First one is for business meal. So it's for business reasons. For us, it's marketing and networking, or maybe like we have the whole group and discuss about the new tax law and also help the client to solve the like the real estate problem. So that's the meal can be business related. And also we need to make sure that we need to keep the receipt. And one of the best practice on the receipt, at the back of the receipt, please write down the business purpose, either networking, marketing, or other related business reasons. And also make sure that you write down the people with you together, so that we clarify on that. And the other new change for this year is for 1099K change. And some of you might notice that if you sold stuff in eBay before less than 20,000 or less than 20 transactions, eBay won't give you 1099K. Start from this year, I saw that some of our clients, they sold stuff like 4 or 5 used stuff in eBay. They already received a 1099K for like $1,000. So it will keep coming. If it keep coming for 2021, 2022 and move forward. So if you receive the transactions more than $600 from PayPal, from Venmo, etc., you receive the 1099K for that. So that means that IRS will have your information regarding the electronic transfer. So the one thing I noticed that Venmo or PayPal, for example, today we have the group dinner, and Christy is very nicely paid the bill for all of us. And at the end of the dinner, each of us will pay Christine for our own portion meal. So Christine will receive the Venmo or PayPal or Zelle on her account. And one thing I would like to draw attention, when we transfer the money, make sure that that's for personal, please check personal. Otherwise, Christine will receive 1099K next year for the meal we eat together. So Christine had to report that portion on that. And this is new, so that's come up on the December last year, so on the 1099K, and you can refer to the ICE 1099K instruction on that. Okay, so next, let's go to the tax saving strategy for the real estate investors. So again, I want to refresh your memory. And this is the California home price since 1990. So as you know that, and we go through and up and down. So if you see the lowest point over the years, that is on April 2009. And you can see that the average home price in California is about like 290,000. So right now, I mean, I know that it's more than 850,000. So what that means? I mean, our price, our client, if buy the house, we are with our professional help, they're making more than 3 times more than what they purchased. And let's take a look at the nice problem here. So here's the chart with the states with the highest capital gains tax rate. And you can see that we have a different color. And if you see that the green color is no tax gain. For example, in Texas, the no capital gain. In Wyoming, in Nevada, Washington, that's no capital gain. That's in green. And if you see the light green, and there's less on the tax on the capital gain side. And one thing I would like to draw attention, if you see our state, California, that's red. That's red. California is the highest state, highest state for the tax rate, which is around 13.3% on the interest rate. So that brings us on a nice problem on our clients. When we sold the house, we had the capital gain. Besides, we pay the long-term capital gain for federal, which 15%, and also our client most likely might be hit 13.3% 0.3% on the capital gain side. So the highest will come up around 27%. And if California AB 1771 pass, and also additional 25% for our investor. Let's take a look at some samples, and then I will go through those 12 solutions with you. The first example is Andy bought his primary home in San Gabriel, and the purchase price is $570,000, and it's on April 3rd, 2020. Now his house is in escrow. The selling price is $815,000, and it's going to be escrow is closed on March 28, 2022. So I highlight those keywords in red. So 570, and then the capital gain is around 245,000. And also they purchased on April 3rd, and it's closed on March 28. Let's take a look at the solutions. And Andy had two options. The first option, sold the house and pay the tax, $61,500. And the second option, sold the house and don't need to pay tax. Let's hold on this one. I will give you an explanation, and after we have the solutions. The second one, and most of us might see those these situations. Michael, because he changed the job, and he had to move out from California to Houston in Texas. The thing is, he bought his house on January 1st, 2021, and he need to sell the house right now, so less than 2 years. So the house appreciate $200,000. The question is, can Michael qualify $203,000 capital gain exemption? I pause here, and I would like to know your answer. Does anyone know the answer? So Michael sell the house as primary home less than 2 years because change job. And can Michael qualify $203,000 capital gain exemption? Is anyone know the answer?
We have one that says yes. Someone says no, no.
Very good, very good, very good, very good. So maybe you might have those questions. Our time we might ask those questions.
We have a mix of yes and no's. Maybe.
Oh, nice, nice.
My guess is no.
The guess no? Okay.
My guess is no, because of the 2 years out of the last 3. They haven't lived in it for long.
Yeah. So let me give you an answer, and also I will come back to the I section code to you. The answer, yes. He can qualify partial exemption, $203,000 partial exemption. And I can give you the explanation in the next few slides. So keep those in mind. So if we have the client, they want to sell the house, and they move out the state or become sick or move out of state in less than 2 years. Right now, they don't need to wait for 2 years, and they get the partial exemption. Each person, $250,000. Okay, so let's take a look. Let me give you the I section code first, and I will go back to explain why it's partial. So the first one, everybody know that we have the section 121, which is $250,000 capital gain exemption for primary home. For husband and wife, we have $500,000 capital exemption. So I know that everybody know about this exclusion. So that one had to be primary home. And also at least 24 months or 722 days every 5 years. The way it works, when we sold the house, we looked at 5 years. And you don't need to live in the house continuously for 24 months. For example, the first year I lived 3 months, and the second year I lived 10 months. As long as in the 5 years, you add up is 24 months or 720 days, you can qualify the $250,000 or $500,000 capital gain exemption. And one thing I would like to draw attention, this capital gain exemption, it cannot take every year. So for example, this year I sold my parent home, and next year I sold my parent home. You cannot take the 250,000 or 500,000 exemption every year. You have to be take every 2 years. Yeah. So one special case I would like to draw attention. Maybe everybody will know about those before. And the one special case is if my primary home, I live in primary home, and later I switch to rental. Do I still qualify for the capital gain exemption? So I need to see the answer on that. So the question is, I leave the primary home for 2 years, and later I change to rental for 2 years. The question is, can I still qualify on the capital gain exemptions? So
we got yes, a lot of yes.
Yes, that's good.
C, even.
Nice, very good, very good, very good, very good. But one thing I would like to draw attention, the tax treatment between the first step, primary home, then rental, the first one. The second one, rental, then primary home. The tax treatment is different. To answer the question, yes, we qualify the capital gain exemption. You're all right, you're all right. But the tax treatment is different. So first one, if it's our primary home, we convert to rental, and later we sold, and we're looking for 5 years. 5 years, look back 5 years, and if you have 2 years at the primary home at the beginning, you qualify the 250,000 and 500,000 exemption. And the depreciation, I mean, when you rental, you do the depreciation. Depreciation had to add back, cannot be deduct. So you pay the tax on the depreciation portion. That's the primary home to rental. So the other scenario, we have rental, then primary home. So for example, we have the house for 10 years, and we rent out for like 7 years. And later we move in to live there as the primary home for 3 years. And the tax treatment is different. Yeah, to answer the question, yes, you still can qualify the capital gain exemption 250,000 or 500,000 for couples, but only you have to take the portion. In this case, we had to separate 70% for rental, 30% for primary home. And on the primary home portion, you qualify the capital gain exemption. For the rental portion, you have to pay the capital gain. Okay, so next one, we take a look at the partial exclusion. On the example side, Michael sold his house because change of job. So he doesn't live in the house for 2 years, 1 to 2 years at the primary home. So he lived there only 1.5 years. So when he sold the house, he still qualified the partial year exclusion. So let's take a look at the scenario, what situation we can qualify for the partial exclusion. The first one is health problem that require you to move. For example, people have allergy, so cannot live in the area, had to move to the ocean, near the ocean side. So they have the doctors know and mention that because they have problem and require him or her to move somewhere nicer. So that portion, they qualify for the partial exclusion. The other thing is change in employment. So if you switch job and if move, the new job is more than 15 miles away from your house live. So you still can qualify on the partial exclusion. So in Michael's examples, so he lived there for 1.5 years, and it's not enough for 24 months or 2 years, but he still can qualify 75% of 250,000 on the exemptions. So in other words, in this case, and Michael can qualify is about 187,000 exclusion in that case. So I want to be sure with you on that. Like for the section 121, 23,000 exclusion, not only 2 years. If you less than 2 years, you still can qualify for the partial year exclusion. And also the other things, you might be qualified exclusions. I would like to draw attention because COVID-19 and some of our clients lose job and they cannot afford for the payment for the house payment, so they had to sell the house. So less than 2 years, if they qualify for the unemployment, and if they sold the house less than 2 years, they still qualify 23,000 capital gain exemptions. So let's go back to take examples and what is our solutions. The first example, Andy bought the house and the capital gain is 245,000, and the house is almost 2 years. It's almost 2 years. So that one is less than 2 years. So he had either like qualify the partial exemption, or my suggestions, he just wait for next week. So because April 2nd, 2022, that is 2 years. So if he wait for 1 week and let the escrow close 1 week later, and Andy will save the tax about 61,500. So that's the timing is very important. So the second example we talk about Michael. So everybody know that we have the partial year exemption on that. The second things I would like to mention that I would recommend, if on the tax saving side, own the property more than 1 year, or more than 1 year. The reason why I have more than 1 year is because the ordinary, if longer than 1 year, there's long-term capital gain. And in some cases, our clients sold the property, and for long term, they might not need to pay tax. Let me give you a scenario. So here's the table for the long-term capital gain for 2022. So if you take a look table on the horizontal, we have 0% tax rate, 15% tax rate, and 20% tax rate. For example, single, if the total income less than 41,675, and the long-term capital gain, they don't need to pay tax. So if you verify jointly, the total, the taxable income is 83,250, and the long-term gain, you don't need to pay tax. So let me give you an example. I have the retiree. They retire. So the only income they receive is Social Security. And they sold the house, restructure every year, and they report the taxable income about 50,000. So add on their retirement. So this couple less than 83,350. So that means that the house they sold, they don't need to pay the capital gain. So again, this is the taxable income for the year. So total taxable income is not the capital gain side. So that's one thing I would like to draw attention. So let's go back to why I propose, on the tax saving side, you own the property more than 1 year. Because lately I noticed that I watch very closely. So if you flipping more than 2 property in a year, they have the risk. Right now, the way it works, we sell the house, we pay the capital gain. Most people 15% on the federal side. But if IS classified as the self-employed dealer, just like us, we make a commission on the real estate side, So when we get the 1099 NEC, we had to pay the self-employment tax. The same thing, if you are the dealer flipping the real estate, and they might classify you as a self-employed. That means that all the income you have to subject to self-employment tax. Okay. So so far, I mean, I still have 10 more like solutions to bring up. Anyone have any questions?
I think there's a few questions in the chat box
Okay.
from Joe. What
Okay.
about starting a primary home, then rent out, then primary home again? How does that work?
Okay, so let's go back to here. So that's really good questions. So we start primary home, then rent out, then primary home. So we take a look the first one. We have 250,000 or 500,000 the capital gain exemption. The code, the section code is we look back to 5 years. Look back 5 years. So let me make the assumption here. So we bought the house 5 years ago as a primary home, and we lived there for 2 years, and later we rent them out, and then we move back as a primary home. So the question is, do we qualify the whole 250,000 or 500,000 capital gain exemption? Yes, it's in this scenario, it qualifies to the 250,000 or 500,000 exemption. And only catch is because we rent out the property, over the year, we take out the depreciation, deduct on the depreciation. So only add back is the depreciation, have to pay tax on the portion, that portion of depreciation case. So that's one scenario. The second scenario is we have the primary home, we rent out, and then we move back as the primary home. So that scenario, I make assumption. So because each client is different, so let me make an assumption here. For this house, maybe they bought the house about 12 years ago, 10 years ago, make it easier. So they lived there about 3 years as a primary home, and then they move out and rent them out for another 5 years. And then they move back and live them as a primary home. So when the house was sold, we look back for 5 years. Look back to 5 years. So the questions on the 5 years, the starting point is rental. So that way we have the rental, the primary home. So that portion, the portion on 250,000 or 500,000 can be excluded. So it's different as the first scenario on that. Yeah. So I think that tax code is case by case, depends on our client situation on that.
Okay, thank you so much, Jeff. And we have a follow-up question that's kind of related. Can exemption, the 250K, apply if only one of the spouses lives there? Okay. So the question is only one spouse live there. Can we apply for the 250,000? Other spouse can qualify on 250,000? The answer yes. Answer yes. So if the spouse live there and they're not on the title, and when you sold the property, if they're married, so they still can qualify the time for 250,000 exemption. Thank you so much. And would you like to continue or have a few more questions?
Yes, okay. I would like to continue. I know that today I might be a little bit out of time. I try my best to cover most of the material here. So I have 12 different text solutions. So I skip very quick, and later if you need more detailed information, maybe we can you can join my and other sections. I do the different sections on the community side, so I will talk more on those stuff. So 1030 exchange. So I know that most people, all of us know that the 1030 exchange, that's the lifetime exchange, and to avoid the capital gain tax and connect to defer the tax. So the things I would like to draw attention here, and for 1030 exchange, there's a timing. 45 days, you have to help the client to find the replaced property, and 180 days have to be closed. And one thing I would like to draw attention is if you have the client do tendering exchange after November 15, please ask them to file extension. Because the reason why 180 days is either the due date of tax return or 180 days, which is early. So for example, if you have the client do the 1031 exchange, sell the house first in December 1st. So the question for you, what do you think? What's the due date? What's the deadline for 1031 exchange? So the question is, we have the client do the 1031 exchange on December 1st. What is the last day to complete the 1031 exchange? Is anyone get the answer?
I don't see any answers yet. Anybody want to take a shot?
Yeah, give it a shot. I mean, that's definitely helping the client.
6 months, 180 days after December 1st. Someone.
Okay.
May 31st, April 15th, May 30th.
Okay, who's the April 15th? Give
April
yourself
15.
Give
I
yourself
hope you say your name right. Bingson?
Yeah. Very good job. Very good job. So that's the things, I mean, before the due date, I would like to look into your clients. If any of them have the tendering exchange after November 1st, please ask them to file extension. Extend the due date. So if you don't extend the due date, let's take a look this way. The tax return, the due date, this year is April 18. And 180 days, maybe in my case, that's May 15, but the things with either or, which one is early? So that thing, maybe I give you homework. So any of you have any tendering exchange client, and if they haven't completed the transaction for 2022, if they have booked sell the house in November 1st, please ask them to file extension as soon as possible. So the next one, we talk about the tendering exchange. So you have 3 property and 200% rule and 45 days limit and 180 days deadline. So I know that I have 5 more minutes for that. So I still have a lot of slides to go through. So let me go through the key slide for you first. So I'm skip that one. One thing I would like to draw attention. Does anyone know that installment sales? Installment sales, very good. I know that a lot of you know the installment sales. The way we do installment sales, we defer the capital gain, and we split out the capital gain over the years. So, for example, in my first example for the retiree, and they have the capital gain around 200,000. So if I split them in 5 years, so every year we realize around 40,000 on the capital gain. And if you come back to the slide I showed you on the long-term capital gain, so if their total taxable income less than 83,000, that means that they don't need to pay the tax for that year. So that's one of the techniques we're helping the client to reduce the tax by using the installment sale. So that's one thing. And here's examples. So we can split out the capital gain in this case. So the next things, we need to let the client maximize their deduction. So that way, when we file tax return, we can maximize the deduction. One thing I would like to draw attention is depreciation. Depreciation, that's a nice thing for real estate is the tax shelter for depreciation. That's the paper loss. So the client didn't need to put the money out, but we can deduct expense. And the next thing is the 20% deduction as the QPI. So with the Trump new tax law they passed, if you are the real estate business and you consider trade or business, and people might be qualified for 20% QBI. So I just give the warning before we take the 20% QBI, the deduction, you make sure that we qualify that, because I lately looked into very closely. So for example, we only have 2 rental property. I hired the management team to manage the property. Can I qualify 20% deduction on that? The answer most likely no, because I mean, you have the management team to manage all the real estate, and only have 2 rental property. That's the passive income. So you might not be able to deduct the 20% deduction. But I want to draw out this the technique here is for the real estate investor, and you consider your trade or business, you might be able to deduct 20% deduction on the income side. Yeah, so the next step is the tax shelter for the depreciation. So examples here, I have the 1.5 million. The land value is 500,000 and the building value is 1 million. So every year I can deduct 36,260 on the depreciation side. So most of our clients, they buy the real estate and they rent them out, they get the income because depreciation. Most likely, they might not need to pay too much tax on that. Yeah, I know that I have 5 more minutes. So the other things, that's one of solutions for the AB 1771 is use your retirement to invest real estate. So here's the catch: you put the retirement money like 401k or self-IRA or SEP-IRA or IRA into it's called self-direct IRA. Let the self-direct IRA hold the real estate property, and the money inside is sheltered, so you don't need to report income within the self-direct IRA. That's retirement, just like the way you buy and sell the stock with your IRA. So that is one of technique. Use retirement and use a self-direct IRA. And the other thing is, like, a lot of us helping our client to buy the property, and sometimes if they're out of the cash, maybe they might be considered borrow the money against the equity, so that way they have the down payment to buy another property on that. So in that case, when they need the money for down payment, they either sold the property or they borrow against the equity. So if they sold the property, they have the tax. If they don't sell the property by borrowing, they don't need to pay tax. And that's one thing, is a special tax code. Let me give you like the example why I propose owning your property. So for example, we have the property, we bought it 20 years ago, around 200,000. Right now it's worth 2 million. And when we sold the property, we can use the 1031 exchange, or we just give to our kids. I don't recommend we give the kids property soon. The reason why, if you take a look at this tax code, ISC section 1014, we have the step-up basis. For example, we buy 200,000. When we go to heaven, the house worth 4 million. So when the kids get our property, when we go to heaven, and they sold the property, so they don't need to pay the tax on the capital gain side. So if we give the kid and then they only have 200,000 cost basis, and when they sold at 4 million, before we go to heaven, they have to pay around like 2 million on the tax side. So I would like to draw attention. That's one of the special tax code, IRC 1014 on that. And the other things, the comments is on the tax loss harvesting. The reason for I propose this one is, for example, we have loss from the stock side. We can use the loss from the stock to against the capital gain from the real estate. Yeah, I know I'm out of the tax time, so I just give example and in what scenario we use which section we use on that. And one thing I would like to go back to the key things we talk about, can I qualify the 1031 exchange for my primary home? The answer depends on, and yes. So let's take a look at, we use the combination for section 121, means that you have capital gain exemption, 250,000 or 500,000 for the spouse. And 1031 exchange defer the tax. So you can use the combination for both. So the as section code, you can take a look at, it's called as revenue procedure 2005-14. On the revenue procedure, they talk about this technique on that. So let me give you an example on here. So I have the scenarios. Some of the clients come to me, and for example, they have house in San Marino, and right now it's worth around like 3 million, and they bought the house about like 1 million. The capital gain is 2 million. Even though we use the capital gain exemption, and they still have the capital gain around 1.5 million. So the question for them, can I use 1031 exchange to defer the tax? At the same time, can I take advantage of section 121, 250,000 capital gain exemption or 500,000 exemption? The answers, it depends on, and the answer you might be yes. So to see how you plan ahead. So in this case, let me give you an example on this case here. Our house purchased on April 1st, 2018 as the primary home. The purchase price is 400,000. And they move out and convert the house to a rental property on May 1st, 2020. And they sold the house in 2022 and for 1 million. And they can qualify for 1031 exchange for the like on that. So for in this case, in this case, the cost base increased. So the first one, they qualify 500,000 capital gain exemption as a couple. And right now, when we do the 1031 exchange, the cost is not 400, it's 900,000. So in the future, when they really want to sell the house, they reduce the capital gain. So in the case for San Marino clients, and if they live there as a primary home and then the house appreciate a lot, so maybe they consider technique with the capital gain exemption and 1031 exchange. So first one, they live there as a primary home, and later they move out and rent them out. So I mean, I want to be real, so not like on paper rent them out. So at least rent them out for 2 years, and with the market value, you put on the market for rental, and after 2 years, and you can use the 1031 exchange to be to defer the tax. At the same time, increase the cost basis. So I know that my time is up here. And the last things I would like to draw attention for the foreign real estate investor. I see that will happen a lot. And if we help the foreigner to buy the real estate and rent them out, make sure that the first year is most important for them, because for the rental income for the real estate for the foreigner is 30% of the gross income. So they have to make the election. They have to make a special election to elect, to deduct all the expenses. Otherwise, they have to pay the 30% of the rental income as the tax on that. So, and I have a few more minutes. So I would draw attention on the special day. Don't forget the due date for April 18 for 2021 individual tax return. So if you have planned to do the 1031 exchange after November 1st, haven't complete the transactions, please file extension. And also the transitional IRA and Roth IRA contribution, the due date is April 18 also. And also one thing I would like to draw attention is HSA, a typo here, health saving account. The contribution as a self-employed, we need to take advantage for the our benefit. And HSA, just like the Roth IRA. So every year as a family, you can put down 77,200 on that. So that way, we will cover our health insurance, health expense on that. And also last, and for 2021, the business tax return for C corporation is due on April 18. So I know that the tax law change every day, and for me, still every day I'm learning. And also I'm glad that I have my partner with me. So we do a lot of research on the tax code side and present you the tax on those solutions for the tax side. So I would like to take this chance to thank you for St. Gabriel, West St. Gabriel Valley Realtors, give me the opportunity to share with you my research, my professional knowledge with you. So I would thank you for Huang, and thank you for Christine, and thank you for Jeff to arrange the presentation today. And all back to you, Christine.
Thank you so much, Jeff, for valuable information. So we have a few questions if you're okay answering them. We have one from Jessica. She asks, is the total income the same as AGI, adjusted gross income?
Yeah, the adjusted gross income is the AGI, that's correct. And it's different from the taxable income. So the taxable income is minus either standard deduction or itemized. They come down to the taxable income. And also the tax bracket is based on the taxable income. So let me share with you. So Christine, how much time I have? So
you're about 8 minutes, right?
8 minutes.
Yeah.
So how many questions I need to answer?
Let's see. We have maybe 3 or 4 more.
Okay. Yeah. So let me quick sharing on the table here to answer the question. So you can see that we have the taxable income, and also if you take a look, that's 2022 tax bracket here. That's by tier. That's by tier. So that means that, like for example, we are married Fan Johnny. So in the first 20,550, it's on the 10% tax bracket. So our tax bracket from 10%, 12%, 22, 24, 32, 35, and 37%. So one thing I would like to draw attention is on the 37% tax bracket. So if our tax bracket on the 37%, our long-term capital gain is not 15%. It's going to be 20% on this tax bracket. Okay.
Yeah, thank you so much. I wish I'm in that tax bracket. I don't have to worry about it now. But the next question we have is a Yasko. It's about let's say someone sold a house in 2020 October, and the client lives in the former rental house from 2020 February to now, 2022 April, for 2 years. Can this be qualified for exemption? Or does it go by the sold date, or does it go by the start living date, like living in the house date?
Yes. So the way it works, 2 out of 5, we look back. We start with the sold date. Once we sold the sold date and look back 5 years, we take a look during those 5 years and how many days as the primary home. So to determine on the capital gain exemption.
Gotcha. Thank you. That's very simple. Okay. Let's see. Clarence has a question. Can we use this exemption multiple times? Oh, it's every 2 years, right? But we can
every 2 years.
Unlimited, meaning you can use every 2 years, so on and so forth.
Yeah. So let me share my experience on that. I have my sister-in-law. She's the high income. So every 2 years they sold the property and claimed the capital gain exemption. At the time, the kid and the first time the kids were very happy because they get the new house, and the third time the kids not happy. They don't want to unpack. So they will ask their mom, "Are we going to move in the next 2 years?"
Yeah. Thank you so much, Jeff. Someone asked, do you have an office in Orange County?
Yes, we have the office in Irvine. Yes.
Okay, great. If you can, please share with us your address later. We'll contact you later. And let's see. Another question. If borrowed from an investment property, is the interest deductible?
Yes. So the question is, we have the mortgage against the investment property. So yes, the interest expense is deductible. Yes.
Excellent. And are you still accepting new clients?
I mean, can I not answer these questions? Because I mean, for me, I'm just like for the education on the public service, I won't answer these questions. But thank you so much for
Yes.
attention.
Thank you. Thank you so much. Let's see, is this the challenge with 1031 exchange from primary home converted to investment is that you have to buy a property with a higher price, right? So it's very tough to do. Someone says, yes.
Yes.
For San Marino property example.
Yes. So I have recent case on that. So we sell the house. I mean, we try to buy the like kind property. So we cannot. So I have a case. My client sold the property in San Francisco, and the high price, and then they buy the house in here, a little bit lower price. So we have the put. So that means that they can take the portion. Portion is the deferral, and the portion over the portion, we calculate the capital gain on that portion. To answer the question, yes, 1031 change, it can be not the same. So you just pay the tax on the difference.
All right, thank you. And someone asked, when are you ever going to have Chinese? This class in Chinese?
Yeah, I have Chinese in Chinese.
Okay,
yes.
Great. Thank you so much, Jeff. I think that's all the questions we have today. I really want to thank Jeff for being here, especially during this really, really busy tax season and sharing with us all this valuable information that otherwise would be very hard to understand, but you really made it easier for us to understand with your slides as well. So everybody's saying thank you very much. And on behalf of the West San Gabriel Valley Association, we would like to thank you, Jeff, for coming here today. Thank you so much.
Thank you so much. Thank you so much. It's nice to see everybody.
Nice
here.
to see you
Yeah.
too. And bring it back together, Jeff.
Thank you, Christine, and thank you, Jeff. So on behalf of West San Gabriel Realtors, we'd like to thank Jeff Huang for being our guest speaker and for your informative presentation today. We have an amazing lineup of useful and interesting upcoming classes. On March 23rd, we have the Realtor Property Resource and Savvy Card. April 5th, Cyber, Social, and Identity Protection. April 12th, our commercial seminar, What's Going On with Multifamily in the San Gabriel Valley. We hope to see you then. Until then, goodbye.
Bye. Thank you.
Bye-bye.
Thank you. Bye-bye.